Today our discussion is on passive real estate investing. We talk the differences between passive and active investing, differences between stock market investing and real estate, and we cover the entire syndication process. All your questions answered. You don't want to miss this. The show starts now.
Are you a trader or business owner? Or anyone just wanting to learn how to be healthier, better, and more business savvy? You've come to the right place. Welcome to A Trader's Life with your host, Rick Mazer.
I have Brad Shepard on the podcast show with me today. Brad has been investing in real estate. It's been part of his life since his college days. He's earned his undergraduate degree in finance with an eye toward commercial real estate, interning with one of the premier large commercial property portfolio companies in the Northwest. He purchased his first rental property within months of graduating college and quickly added several more. His experiences include managing hotel and vacation property, developing retail and hospitality space, and raising capital from domestic and international investors. He's been exclusively focused on capital raising for commercial syndication since 2017. And on that note, good day, Brad.
Hey, Rick. Good day. Great to be here. Thanks for having me on.
Everything's going great, I hope.
Absolutely. Yep. Life is good.
So obviously we're talking real estate investing today, and I know you're primarily focusing on the passive investing through the syndication deals. And I just want to take a quick introduction here because I know most people have heard about real estate investing in general, but maybe not so much syndication. So can we just first explain the differences between passive and active investing?
Absolutely. It's one of my favorite topics because, yes, investors know how beneficial real estate can be to a portfolio. When they think about what their options are, it's landlording, it's flipping, or some REITs, right? And lots of people don't want to deal with the landlording side and all the hassles that come from that, or going out there and doing the, fix and flips and dealing with contractors and paint and tile and all that stuff. And so then they think about just REITs. But the syndications allow investors to participate directly into these real estate properties without having to be involved in the day-to-day management of them like a landlord would be. Even if you got a good property manager, right, you're still going to have stuff float to the top. I can tell you some current nightmare scenarios that I'm dealing with a good property manager in place, but yeah, I still get the stuff floating up from the tenants and code enforcement and yada. So the syndications, that's simply a fancy word that means group investment. That's it. And you generally have what's called an operator or a syndicator or a general partner. Those all mean the same thing. That's the individual or the entity, or generally individuals who are running the show. They're the ones dealing with the property management. They're the ones dealing with the day-to-day stuff. And then we sit in on the limited partner side or the passive investor side, where we've simply provided capital to those general partners to execute this business plan, to go buy this asset. More often than not for us, it's apartment complexes or self-storage units or mobile home parks. But it's simply putting your bet on the table and then watching the managers go. Not unlike what we're used to in the stock market, right? You don't have control. You're putting your faith in these managers to execute their business plan. Same thing with the commercial syndications. And so you're not dealing with any drama. We use the phrase all the time, hassle-free real estate, and that's what the passive syndications provide.
Basically, the idea is that while you could do it yourself and be the landlord, do all the flipping on your own and theoretically make a little bit more of a return, you're also going to put a lot more of your time in as well. And with the syndication deals, you're going to still make a very good return, ideally, hopefully. But you're going to be doing it in a more passive way. So it's literally just you're collecting the money and that's it. And you don't have to deal with all the headaches.
And yes, I've done some fix and flips where we've hit it out of the park. We've done really well, and that's provided great capital for us that we've now deployed elsewhere. We've had some fix and flips that have completely flopped and did horribly with those. And then same thing on the rental side. We have some rentals that are pretty easy to run. I've got a fourplex in a town in Texas, just north of Austin. Pretty simple to run. It's, C class, got good property management there. I don't really ever hear about it. And then I've got a fourplex down in San Antonio. It's a D class and a good property manager, tons of drama. And, on paper, the returns look phenomenal. In reality, it's pulling teeth to get 2 or 3 of them to pay each month. So it's the returns to counter, one piece that you said there. Looking over the last 4 years now, we have done better on the passive syndications as a passive investor than even what I'm doing on my own portfolio of single family, which I'm 1, 2, 3, or 4 unit rental properties, and doing better on the returns. Plus, it's being hassle free. For me, it's a win-win. It's a no-brainer.
Especially if you're a busy professional and
Right.
you've got some extra capital. You might not want to run on the weekends and start fixing drywall and doing all that kind of stuff. So this offers another alternative.
Exactly. To that point, I shared it before we jumped on here that my family and I, we just moved from Texas up to Idaho. And one of our last weekends there, we wanted to go down and hang out in San Antonio for a bit. And as we were down there on Friday night, a bunch of drama popped up at that fourplex that I was talking about. So I spent, instead of hanging out with the family that Saturday morning like we had planned, I spent 3 or 4 hours over at that property dealing with nonsense. And it just solidified for me why I want out of that. The active management of these properties.
I get it. Me too. I had a couple of them myself, and I'm just at an age where just let somebody else deal with that. And sure, the general partners are going to make a little more, but
sure,
they're also getting the loans. They're finding the deals. They're dealing with the management company, all that stuff. And we'll talk about more of that in a little bit. What about, because a lot of people, obviously, they invest in the stock market. That's the thing you do. You invest in the stock market. You let your money grow theoretically. What's the differences between the real estate versus the stock market? Why would somebody, besides just passive investing, but just real estate in general versus the stock market, do you believe that there should be an equal mix, or are you more heavily weighted towards the real estate?
I am certainly biased, and I am more heavily weighted towards real estate. I do have a small stock portfolio. It's fun for me. That's my play money. I've got some in ETFs, automated investing, and I have another account where I just pick the stocks. And again, for me, that's just the fun money. For me, real estate is much simpler as far as the principles than the stock trading, especially the day trading. I look at some of the graphs and the charts that the day traders and stock pickers are using. Goes over my head. And that's me as a finance major, right? Real estate is pretty simple. You buy an asset. The product is a place for people to live or a place for people to store their stuff, and they pay you monthly for that. And then over time, the value of that property goes up while these individuals have been paying down your mortgage and providing monthly cash flow. It's pretty simple stuff. And I do having physical assets. It's not theoretical. A stock can go to zero. I've had that happen. I remember early 2000s, I owned a bunch of Delta stock, and they declared bankruptcy. That stock went to zero. With a piece of real estate, at the end of the day, I've got a physical piece of a physical asset that I can drive to, put my hands on, say, I own this. And if it burns down, I've got insurance, or on these passive deals, if an operator ran away with the money or whatever, we still have this physical asset right here. There's just a lot of safety nets that come with real estate. And the returns, I can beat an index fund. These passive investment deals, they beat the historical averages for the stock, for an S&P 500 fund or what have you. Yeah, you can go, maybe your audience has really honed in on picking out some winners in the stock market. But for the average individual, the general index funds, we can beat that on the passive side, passive real estate investing side as well.
And sometimes I feel like it's not so clear cut because, for example, I was listening to a podcast the other day, and a guy came out with some sort of not an indicator, but some oscillator or something like that that's supposed to tell the difference between gold and real estate and oil and all that kind of stuff. And they were talking about how if you bought oil at the same time as real estate 20, 30, 40 years ago, you would have done better just investing in oil and gold than versus the cost of buying a home. But they're not really giving you the whole picture because, I don't know if you remember, but we certainly do because we trade it. Oil went below zero.
Right.
So what are you going to do if you're holding your oil? And it's just real estate that doesn't happen. Real estate can crash. It can go down, of course, but there's a big difference between oil going from $60, $70, $80 to negative $10, which it actually went negative, and real estate pulling back 30% or even 40% in the worst case scenario. So I think people just need to keep that in mind. Real estate is, again, not the be all end all, but it is a very solid thing to be in. And I'm starting to skew my my personal stuff more towards that as well. But what about the tax implementations? Because people say I can invest in an IRA and it's tax-free, it grows. What's the difference between that and why would somebody might want to choose real estate?
Yeah, that's a great question. And just real quick, touching on oil, I just lived in Texas for the last 10 years. And in that 10 years, I saw several cycles and got plenty of friends and family down in Houston. It's a boom and bust cycle. And how would that be if you had a lot of money there just a year or two before you went to go retire, which we all saw in 2007, 2008. So many near retirees, their portfolios just got wiped out. We experienced a lot less volatility in the real estate scene. As far as the tax implication goes, the tax code is written very favorably to real estate investing. And that's what the tax code is all about. It's providing incentives. What does Congress want us to do? And apparently they want us to invest in real estate because they provide a lot of tax benefits for doing so. And if I'm doing this outside of a retirement account, there are a lot of tax advantages that can come through just investing in a passive syndication like this, where there's depreciation that all the investors participate in. So you're getting monthly cash flow, you're getting money in your bank account, but at the end of the year, you're getting a K1 that shows a passive loss. And I'm not going to provide tax advice here, but you can hand that to your CPA, and that could potentially offset a lot of tax liability, especially if you're doing passive investing in other places where you've experienced a gain. And then, yeah, I've used my IRA. Both my wife and me, we use self-directed IRAs to invest in these passive syndications as well. So you can do that. And that's one of my favorite things to educate people about is you've got your IRA. Most people are only familiar with the options they have available to them through a Fidelity or a Schwab account or what have you. But you can take that same IRA, move it over to a different custodian, what we call a self-directed custodian, and that custodian can place that in alternative investments, including real estate. I own a rental property. I sold it 6 weeks ago. I owned a rental property inside my IRA. Sold that, zero tax implications. That's a Roth IRA, so tax-free growth. We use these Roths for these syndications as well and let it ride. So the fantastic tax benefit. But whether you're doing it inside or outside of an IRA, both options are on the table, and there are significant tax advantages. And one thing we could get into is accelerated depreciation, which we do on all of our commercial real estates. We can dive into that if you want. But those tax advantages all pass through to both the general and the passive investors.
A lot of people have heard of REITs, real estate investment trusts. And would you say that the only difference between the investing in just a REIT or a REIT fund and a real estate syndication is just potential bigger returns? Or are there other advantages of why somebody would want to do a syndication over just a regular REIT?
Yeah, from what I have seen, we've been able to do better on the syndication side than just going into a REIT as far as the return goes. And again, I like knowing who I'm in business with. That's one reason I do like real estate as opposed to investing in a mutual fund that I have to dig into the prospectus pretty deeply to understand what companies were invested in here and who's running those. I like knowing who I'm in business with and what my dollars are accomplishing. I like providing housing, good quality housing to people, or good quality storage units, what have you. And the big downside to this, as opposed to the syndications as compared to a REIT, is liquidity. You can be in and out same day, right? A couple clicks of a button, you can be in the investment, a couple more clicks and you're out of the investment. These syndications are not liquid like that. They're meant to be longer term holds, generally 3 to 5, maybe 7 years for some. And so there's a commitment there, and there may be opportunities to some redemption opportunities where you could get your money out, but by and large, you've got to plan on being in there for several years. And so that could be a downside to some people. It's a pro to others, but that's something to consider for sure.
Well, and with the REITs as well, you're basically investing in a big basket. So you have to basically take all of their deals in the fund, correct? You can't pick and choose individually. If you like a particular area or a particular state that you want to invest in for the property, and we'll get into it in a little bit, the different types of deals that they have, you don't have that opportunity as much. It's not as flexible.
Exactly, right? A REIT they have their predetermined parameters, and you look at that and you can take it or leave it. You don't have a whole lot of flexibility in that. With the syndications, you can choose your operator, where are they based, who are these principals, and then you look at the asset that we bring to the table. Okay, it's a 300-unit multifamily, 1985 built apartment complex in a suburb of Dallas. Do you like that market? Do you like that business plan? So you can be much more selective in the approach.
And that's probably why your real estate investment trust returns in some cases may be a little bit lower, because you're getting the good with the bad. Not the good with the bad, but you're basically, it's a big pool of deals and not everyone's going to be a winner. You can't pick and choose. Right. Just something for people to consider. Now, you had mentioned one thing about investing with your IRA, and that there was the custodian companies that will help people do that. Yes. I feel that's important to touch on, because I think a lot of people don't know that. Now, can your company assist with that? Do you have somebody you can recommend for those custodian accounts, or point people in the right direction?
Yeah, there's a lot out there. If anybody listening, you just Google self-directed IRA custodian, you'll find a bunch. And it comes down to, like most things in life, fees and service, right? So there are higher fees in the self-directed custodians than a Fidelity or a Schwab for managing that account, because it is a lot more paperwork to keep track of these assets as opposed to, just a handful of mutual funds or whatnot. But yeah, so we have the ones that my wife and I, we've worked with personally. There are a couple others out there that I know of that are some of our investors use, and we've really liked working with them as well. So yeah, we can certainly recommend some. That we use Quest Trust out of Houston. UDirect is another one that a lot of our investors use. It's the letter U, Direct IRA. And those are ones that your listeners can start with. And yeah, an IRA is an IRA. As far as tax code goes, an IRA is an IRA. A Roth is a Roth. The difference is simply a custodian. We use that term self-directed just really to clarify, what does a custodian allow you to do? That's about it. It's not like there's different tax implications or these aren't different types of accounts. It's just a matter of, does that a custodian only offer stocks and mutual funds, or is that a custodian that will let you do the alternative assets like real estate and other collectibles or investment vehicles that could be put into those IRAs as allowed by the tax code?
I just think it's important, because if you're going to go open up a stock brokerage account, for example, and you hear Fidelity or you hear TD Ameritrade, people are comfortable with that. They know the name. Right. But when you start talking about, let's move my IRA over here, typically these are smaller companies that most people haven't heard of before. And that may be a barrier for some people. It shouldn't be necessarily, but they need to understand this is a very normal thing. And of course, you have to select the right company. But sometimes people are like, oh, I'm going to Google this, and there's a list of 100 companies. You know what I'm trying to say? So sure. I just figure that, especially if they're coming to somebody like yourself, there has to be a certain level of trust, obviously, right?
And self-directed IRAs are getting more and more popular. They popped into the news last month in a big way, trending on Twitter. There's not one self-directed custodian out there that has the type of name recognition as a Fidelity or a Schwab, of course. They're just not that same scale. Recently, I can't remember what the magazine was, Salon or Vanity Fair, one of those, did a write-up on Peter Thiel and how he has taken his self-directed Roth IRA from a few $1,000s 20 years ago or whatever it was when they first launched PayPal, and now there's $5 billion inside of his Roth IRA. That was only possible inside of a self-directed account. And so when that piece came out, it was a hit piece. They were trying to say, look at how bad this guy is. And I'm looking at it like, holy cow, that's awesome.
And the reason for that is because there are certain things that you cannot do if it's not a self-directed IRA, correct? Where as far as type of investments, which will allow you to get more alpha and more return on your money. But if it's self-directed, then you're able to do different things. I know even on the trading side, there's options and futures and different things you can't trade in a regular account. So it's not a bad thing. What was it put there originally to protect people, huh? And then they opened up the self-directed part.
What he put in there was when they first launched PayPal, he put his founder shares inside of the Roth IRA, which meant that the tax implications, the growth on that was going to be tax-free. Of course, we all know what happened with PayPal. He made millions, if not billions on that. And those shares became extremely valuable. And then he used those dollars inside of his Roth IRA to invest in other startup companies. And he did fantastic with those. And again, you couldn't invest in startup IPO founder shares using a Fidelity or a Schwab IRA account. But inside of a self-directed account, you can.
Okay, so let's get into it a little bit as far as more of the details of. So what type of investors qualified to invest in a real estate syndication deal typically? Let's say somebody says, hey, I'm looking at this and sounds good. Let me see if this is for me. What type of person do they have to be?
Yeah, the tax code on this, or the SEC regulations, define two different, for our purposes today, they define two different investment classes that we use, 506B and 506C. more often than not, our investment opportunities are 506C, which does mean that they're open only to accredited investors. And that means you have a net worth of at least $1 million, not including your primary residence, or you make at least $200,000 per year. And you've been doing that for the last couple of years with the expectation of that to continue. And so those are the two most common ways that people qualify as an accredited investor. And we do have to verify that. We have to honor those SEC regulations. But under a 506C offering, we don't have to know you. We can advertise. We can talk about it on the radio. We can talk about it on Facebook. We don't have to have a prior existing relationship. And so as soon as you come to us, you verify that you're accredited, you're in. We can put you right into the deal. A few times a year, we do a 506B offering, which means there are going to be, it's a few dozen, it's 35 seats available for non-accredited investors. Those go pretty quickly. We, like to do those here and there. They become a little bit more cumbersome. We have to show we know this individual who's non-accredited. We have a prior existing relationship. We've had enough conversations. I know that this investment opportunity is suitable for this individual. So those opportunities do come, but by and large, most of these opportunities are available to accredited investors only. It's a shame, to be honest. It's how the rich get richer. There's a lot of money in these syndications. In the SEC's eyes, they want to make sure that we're not out there preying, P-R-E-Y, preying on individuals who aren't qualified, don't have the knowledge or expertise to be able to vet these deals properly, or could not withstand a loss. And they want to push them more towards the public markets, where these are called private placements. They're not as liquid. They're harder to evaluate, etc. So there's reasons why, but it is how the rich get richer kind of a tool. But that's why I do like when we have those 506B offerings, I can get some more folks in there who might not otherwise have the opportunity.
And I know it's typically up to the sponsor. The sponsor is the person who's bringing in the deal. But what is the reason why they wouldn't offer all their deals to those 35 people? Is there a reason?
It is simplicity. Being able to advertise, being able to work with individuals that we don't have a prior existing relationship. It can become, it's simpler. At the end of the day, it's simpler. There are those hoops that we have to jump through on a 506B to make sure that we've taken steps to verify that this individual, this isn't their last or only $25,000, right? Or they're only $50,000. And if they lose this, they're going to go homeless. We have to take steps to ensure that's not going to be the case. And so we do have to prove suitability at a different level than on a 506C offering.
So it's just more work, and you just can't open it up to every deal like that just for time reasons.
Exactly, bandwidth.
It's nice that it's at least offered, like you said, in some of the cases. To that point about somebody not having their last 25,000. Let's say somebody's sitting on a nest egg of some money and they want to put in. Is there a recommended amount somebody should put into any one deal of their net worth? That you personally, either for you, or is it, let's say somebody's sitting on $1 million. They're accredited and they're sitting on $1 million. Is there a percentage that you would recommend somebody put into any one deal as a maximum?
I'm going to go very broad on this because, of course, you want to make sure you've got your emergency fund, you've got your life insurance, your disability insurance in place, all those other things. You're not, bleeding money on a house payment or a car payment or a boat payment or whatnot. But as far as that investment portfolio goes, a number that we toss around a bit is somewhere 20 to 30% of your portfolio being in real estate. That's probably a pretty safe number. For me, again, I'm biased and I go way above that. I have just a small portion in the public markets because I do have that strong preference towards real estate. Where I thought you were going to ask is what are the minimums as far as the people can put in these deals. That's going to be more operator specific. More often than not, they're around $50,000 as a minimum. We have a deal right now we're raising for that. We have a $25,000 minimum. So that can vary. But yes, as far as a percentage of an investor's portfolio, assuming all the defensive postures are in place, then a 20, 25, 30% percentage of the portfolio is pretty, I'd say it is a safe bet.
So if somebody wanted to go 30%, they had $1 million, just for example, for throwing the numbers out, 300,000. And then you would recommend breaking that up. You're not going to put 300,000 into one deal, right? You would probably recommend spreading it around.
We do have investors that will put in large amounts like that with one deal with one operator. I like working with multiple different operators because and being in multiple different deals. Some of them are going to be home runs and some of them are doubles. And so I like to spread them around a little bit. And I like, having some geographic diversification as well. So I work with operators. I partner with operators. One, for example, focuses exclusively in Phoenix. Another one focuses exclusively in the Carolinas. Another does Florida, Georgia, and Texas. And so I can get some geographic diversification as well in placing my money with different operators and different deals as they come along too.
You had touched on it a little bit in one of your other answers about the REITs being able where you could just click a button and move your money out. So I want to talk, since we're talking more about syndications here, about liquidities in these deals, just so people fully understand. They can't just get their money back. This is a long-term investment. So let's say, for example, the sponsor will say, we're anticipating holding for 5 years. And here's the cash flow, here's the distributions. What happens after the 5 years if they just say, we want to keep it? I'm asking because I don't know. I'm just like a listener. Like I'm saying, what do you do? Or what are your options?
Sure. So there's a contractual agreement in place. And the lingo we use, it's a PPM, a private placement memorandum. So when I'm first talking to a potential investor about a deal, I'm going to put in front of him or her the investment summary deck. That's the pretty presentation with all the nice graphics, talking about here's all the great things that can happen and why you should invest in this. And then they say, hey, yeah, I'm interested. Send me the PPM. Now I send them that document. It's 125 pages of legalese trying to scare them away. So that's where we can sit down and review in detail what are the contractual obligations and rights for everybody involved here. And that's going to specify, hey, that we're expecting a 5-year hold, and here are some opportunities where the general partners could choose to extend, what those parameters would be. But they could extend maybe for another 12 months or 18 months at a maximum. And at that point, they just have to sell the asset. And so you would look at the PPM for those specifications. What we're trying to accomplish in that PPM is giving the general partner some latitude to choose when is the best time to sell, and not forcing their hand to sell in a down market after a windstorm came through and put the property in a bad state. And now we're up against the gun to sell the property off too because of the PPM. So we want to give the general partner some latitude to make good decisions. And most of our deals, when they're a single asset deal, we're projecting a 5-year hold. With how hot the market has been and how quickly prices are rising, it's rare that we're getting deals past 3 years, because then an offer comes in and it's just fantastic offer, and the general partners look at it and say, all right, this makes sense for everybody involved, let's sell it. We've had one that we were in and out in 18 months and we all did fantastic on it. And so you've got that latitude, but we go in there with a mindset, let's just put it away in our brain. 5 years, I'm not going to see this capital again for 5 years. It might even push out to 6 months depending on what's going on in the market at that point. And you just set it aside of, okay, I'm not going to see that capital again for several years, just to set that expectation going in.
So it is outlined in the PPM essentially then.
Exactly. The PPM is where all those parameters, who gets paid when, who's first in line, et cetera, et cetera. It's all in that PPM.
And is there ever such a thing, or have you ever heard of such a deal where at the end of the 5 years, a general partner may say, hey, look, we want to keep this thing for another 5 years, but we'll give you the opportunity to exit if you want to, or you have the opportunity to keep your shares and just keep cash flowing? Is that...
Yeah, that certainly can happen. So they would have to recapitalize it at that point, because the original PPM said we have to dispose of it at this time frame. But then they say, hey, we could do a refinance on this property, give everybody their capital back. Those who want to stay in with us could continue to do so under a new PPM, under a new entity.
So be a new deal, essentially, a whole new deal.
And some are structured ahead of time. I know of several syndicators that work that way, where the plan is to never sell. But somewhere along the way, they do some refinances to get that original capital contribution back to their limited partners, so that they're still part of the deal and the returns come, but they've been refinanced out of that original capital contribution. And there are deals where that's the plan going forward. Hey, we're not going to sell this thing. We're just going to refinance it and keep it for the foreseeable future.
I get the liquidity question a lot, and I want to ask you about something that's relatively new in the industry, and that is involved tokenization. I don't know if you're very familiar with that. I do have a deal that was brought to me actually about that, and it's an interesting concept, but I just wanted to hear explain what it is, first of all, and then explain what your thoughts are on it.
Yeah, you know what, Rick, I'm going to be a poor one to answer that one. I'm familiar with the concept of NFTs, and I know of a fund of funds. They're just about to launch here in the next 6 months, where a third of the fund is going to be tokenized. People are going to be able to invest it through crypto. So it's happening. It's going on right now. I don't see us going down that path because it's just not who we are. And again, I like simple. I like tangible.
This company that brought me the deals actually, I think, having a little bit of problem of doing their raise because of it. And basically what they're just saying is they're trying to solve the liquidity issue for some people by basically saying, look, you're going to go into the deal as a normal syndication deal. And at any time, if you want to basically sell your shares, you can sell your shares through the market, through the tokenization system, whereas people can then go buy them from you in that fashion. But again, I think, like you said, simple. I think people are getting more confused by that whole deal to begin with, but I've gotten some emails on it and I just wanted to address it here. It is very new, and I'm assuming there's risks to that as well, because now you're selling your shares to somebody and you're getting tokens or crypto or whatever it's going to be. Again, it's not something people might want to get into.
With how heavily regulated these syndications are, and how obviously it's going to come, but right now the regulations around crypto and tokenization are pretty light. To me, it doesn't feel like they line up very well. And there's so much volatility around in the crypto market still. For me, I'm not a Luddite by any means, because it is an issue. The liquidity piece is a con when it comes to these deals, since it's a problem that's, if people can solve it, great, I'm all for it. But I'll be a slow adopter on that front.
But just because there is a market for it doesn't mean it's going to be a very big market for it. So even though you theoretically think you have that option, you might not get a taker if you're trying to sell your shares on that. So there's no guarantee either in that regard, until maybe years and years go by and maybe it becomes a standard. Maybe it is. Who knows? But for right now, it's not there yet. So you decide. Let's say somebody decides they want to do a deal and they are looking for properties. Can you talk a little bit about the different type of deals? There's yield plays, there's value add plays, there's new construction. What are your thoughts about the different type of deals? Are there deals that you particularly like better than others?
Yes, and I can share. I was actually just thinking about this one specific asset that my wife and I are invested in. In fact, we used her IRA dollars with a style or a business plan that we learned a lot on, and I'm not ever going to invest in that type of approach again. It plays into the liquidity plus what are the potential returns. But yeah, there are different approaches. We let the majority of our deals are in apartment complexes, and then we also do self-storage and mobile home parks. And you can, in almost all of these, we're going in to do some type of a turnaround. The jargon is value add. Where's the value that we can go in there and contribute to this deal? Whether it's updating these units to current expectations of what the market is demanding, and then raising the rent accordingly to match that. Some of them are operational, where it was mom and pop operators, property managers, and they haven't raised rents in 7, 8, 10 years. They haven't updated the laundromat. They haven't put in the Amazon lockers or the dog park. We know we can go in there and input some operational efficiencies to increase the value of the property. So we're generally looking at value add, B minus type properties, maybe built mid 80s, mid 90s, those kind of deals. There is a lot of money to be made on new construction. And I know some folks like here in Boise, the construction here is just going gangbusters and they're killing it, 30-40% IRRs. But you're going to be sitting there for 2 years, 3 years without any cash. So that's the trade-off. With the deals that we do, we're buying existing streams of income. Month one, we're all getting distributions. And I do like that. Most of our investors like that. If you go into the new development, you're going to have at least a couple of years, 18 months at least, where you're not getting any distributions until that property is leased up and stabilized. The very first deal that we did, the one I was thinking about when we were talking about illiquidity, we went in strictly as a limited partner. It was when I first started thinking about, getting back into the commercial real estate scene. How do I do this? I want to learn. So I'm going to go in as a passive investor here. And it went horribly. and it was supposed to be, I think it was supposed to be originally 18 months. 4 years later, we don't have our money back. And so it's been a rough one, and we're locked in. We're waiting for the general partner to sell. We're getting monthly updates. So he's tried to tell us what's all the nonsense that's gone on with this property, but it was a deep value add play. In a market, we shouldn't have invested it. It's about an hour and a half south of Houston. So it's really outside of the main population growth center, not far from the coast. And with the idea of going in and building several new unit buildings on this property. And Hurricane Harvey came through and wiped it all out. We've gone through 3 different property managers there. So insurance came into play, bad zoning has come into play, the bad management has come into play, and it's just been a perfect storm of nonsense. And here we are 4 years later, and we still have our dollars locked in there. The protection is we still have that physical asset. We can still sell that. We're in a position there where the dividends are accruing. So when we sell, we haven't been receiving distributions on those for the last 2 years, but when it sells, those will be made up, and so we'll be made whole when it does sell. But it is illiquid, and so we've just been sitting there waiting and waiting. And so what we learned from that is no deep value add. Get closer to the higher density population centers, simple value increases in places where lots of people want to live, rinse and repeat.
Talk a little bit about on the value adds and things like that. For people who don't understand, they're going to probably hear terms about Class A, Class B, Class C type of properties. Can you just give us an overview of the differences between A, B, and C? Do you like particular type better or not?
Right. Class A, newly built, got all the fancy amenities you can think of, the fancy pool, probably close to downtown, or maybe the sub-downtowns that are lots of metro areas. It just feels nice, right? Premium rents. They're new enough that there's not really an opportunity to go in there to buy those, to turn them around, to fix them up, to increase the value. They're already valued very highly. B class is where most of us would also feel comfortable living. They're maybe 10, 15, 20 years old, and they've got the clubhouse, they've got some of the playground out in the area. Maybe they have some storage that people can rent as well. And then C, it's all subjective. You can look at it and see maybe the parking lot hasn't been updated for 10 years. It's pretty cracked and ugly, and maybe some of the fixtures and the signage up front is falling apart. A little rougher neighborhood, whatnot. And so it's not a war zone by any means. And there's actually a lot of money to be made in those C-class properties. And most of us could also be comfortable there if we go in there and do some updating. So those definitions are very subjective, but we like the B-, C+ type arena where there's an opportunity to go in there and do some updating, and we're not necessarily trying to change the classification, but just optimize for that market.
Okay.
Was that helpful?
Yeah, that makes sense. Because like you said, there's B-, they call them A, B, or BC. So there's just a general ballpark of people have to understand what type of buildings they're dealing with and the pitfalls. And you could do a lot of research online as well and on Google, or they can call you and of course ask you as well, I'm assuming. But there are differences in there. I want to go back for a second to the minimum investment. You had said that typically they're around 50, but some are as low as 25. 35. Is that correct?
Right. The vast majority of the deals that we do and that we see in the market are $50,000 minimums. We do have one deal we're working on right now. It's actually a fund. It's with a single multifamily operator. We're buying 5 to 7 assets inside of this fund. And because of the fund structure, it allowed us to be more flexible, and we were able to do it at a $25,000 minimum. And so that's been nice. I've been able to get a lot of people into that one that were more comfortable at that dollar amount, or just that's what they had available. But yeah, by and large, $50,000 is the common floor.
And they could invest more if they wanted to, of course, but that would be the minimum.
Yes, please. There's a cap. There might be like a $3 million maximum just for various reasons. There's generally a cap, but yeah, the $50,000 is the floor with the option to go anywhere in between that floor and the cap.
And you like those self-storage units, huh?
Yeah.
30 years ago, I see these self-storage units pop up and I'm like, geez Louise, what a gold mine. I didn't have any money. Like I wanted to build one, my own. I was like, this is like unbelievable. I didn't have any money. Now, is there still an opportunity there through syndication to make money with because I have not done anything with it, but now that I'm seeing that they're doing it in syndication deals, I may look into it.
Yeah, we partner with an operator called Reliant. They're one of the top 20 as far as unit count self-storage operators in the country. And we're doing fantastic. We've been really happy with having our own dollars and our investors in those opportunities as well. It depends on the market. Some markets, it makes more sense to be the one to go out there and build. But in just like mobile home parks and with self-storage, there's a lot of mom and pop operators, and they've got 200 units and they're collecting checks every month from 200 tenants.
Right.
And it's okay, there's lots of room to go in there and hey, let's put in some security cameras, let's put in some automated features here, let's make it so people can pay us through a monthly auto debit, what have you, and just to go in there and turn it around, add some nice features. Maybe we do some HVAC control, climate control. And yeah, there's definitely money to be made, especially as when you can find the mom and pop operators that are looking to sell.
All right, this next question, it can be a little confusing, but I want to try to address it because we've gotten this question before and it can be a little complicating for people. Can you talk a little bit about purchase cap rates? What is a cap rate, first of all? Purchase cap rates, reversion cap rates, which is typically your exit cap rate, and what those should be at, what the differences are, what somebody should be looking for in those regards?
Sure. Yeah, that's a popular discussion topic right now because cap rates are so low, which means you're paying premiums for properties. To find out a cap rate, it's really a function. That is the commercial world's equivalent of getting an appraisal on your house, there, where the value is determined by what's going on in your neighborhood and what your neighbors have done to their houses and how well they negotiated the sales price. So the cap rate is simply what is the average property, similar property in this market going for. So you would talk to a commercial broker, okay, I'm looking at C-class in this neighborhood. What is the cap rate in that area? And that cap rate is a function of how to determine the value of that property. Unlike your single family houses where it's simply determined by that appraisal based on what your neighbors have done, the commercial deals are valued by how much money do they earn? What's the net operating income? You brought in this much revenue. After all your expenses, you're left with this much left over. You multiply that into your cap rate. Now, what is that asset's market value? What could we sell that for today? And if it's, the lower the cap rate, the more expensive that property is. And so that can be something to look for in the underwriting of the deal is sometimes operators will say, hey, we're going to buy it at this cap rate. So let's say we're going to buy it at a 5 cap. And then in 3 years after our turnaround, we're going to sell it for a 3 cap. Yeah, that's a pretty big leap. Why do you feel like you can buy it for 5 and sell it for 3? What's the justification there? That's projecting a really hot market. And we do generally see that we've got a better exit cap rate because we've done some turnaround on this deal. But a 3 to 5, that's a pretty big, or 5 to 3, that's a pretty big leap. And so it's not something you can Google or look up. You just have to talk to commercial brokers in the area who can see, okay, that last deal that sold, it was the NOI was this and the sales price was that, and so now we can determine the cap rate. And they look at that sales history to determine that, and then we can use that cap rate as we're evaluating the deals and whether upon the purchase or the exit.
You're leaving it up to the syndicator, though, and I think the question becomes when they're giving you a prospectus of the deal and they're estimating what your IRR is, for example, your internal rate of return or your cash flow, they're probably projecting that return off of an exit cap rate. Absolutely. Versus an entry cap rate. So if they're off in the cap rate, that's going to be off. So you don't know. Nobody's going to know. It's not like it's not an exact science. I'm not trying to say these people are trying to swindle anybody or anything like that. It's just you have to be very cognizant of that when you're looking at the deal and saying, hey, I'm buying in this area and I could potentially get a whatever 15% return, whatever the number is. But if that cap rate, like you said, 5 to 3 is in there or whatever it is, it may be a little bit too much of an ask for it to be reality.
When you're underwriting any of these deals, there's a lot of assumptions that have to be made, right? It's not an exact science, but we want to go in there with very conservative assumptions. You see some that will write really aggressively. The business plan is to go in there and update from the Formica countertops to the granite, install the backyard patios, the dog runs, the Amazon lockers or what have you. And they say, now by doing so, we can increase the rent each month by $200, $250. That's a pretty big jump. $250. I'd like to see somebody who's underwriting. And what if we were only able to increase the rents $50 a month or $100 a month. Why do you think you can jump $250? That's a pretty big leap. And so those are the areas you want to look at. What are their assumptions that they're making? And if they're telling you they're going to buy it at a 5 cap, sell it at a 3 cap, again, that's a pretty big jump. What are those assumptions? And that would be somebody doing, $200, $250, $300 rent increases. Can you really do that? There are only so many expenses you can trim. So where are you going to make up that revenue? So it's those conservative assumptions that, or I guess I should say, it's those assumptions can make or break a deal. We want conservative ones.
So with what you do, for example, you're trying to raise the capital for these deals, and will you walk through with a potential investor like a particular deal and basically say, here's the deal, here's what I think about it, here's the pros, here's the cons? Will you work with them on that? Or is it just basically like, here's an offering, here's what we offer? I want the audience to get a better feel for what it is that you're doing to help them make the decision to get into the deal. You can't promise anything. I know you're not an advisor or anything like that, but
yeah, my job is really vetting the sponsors first, making sure that these individuals, these groups, these entities have the track record, have the experience, have the teams in place to do what they say they can do. So I'm vetting sponsors. And then as they have deals that come through, I'm also vetting that deal. And the sponsor, I know they have the obligation to go through that apartment complex or that self-storage unit by unit, not just a sampling. I want them to go through every single apartment in that complex, and they do as well. Any operator we work with does. And then we're getting an idea of what is the budget going to be to turn these things around. And that's just part of the due diligence there. And for most of these deals, I'll also fly out to the property, walk through it with the general operators. Based on the day I'm there, I might be able to walk through a handful of the units as well. But I'm going out there and seeing this is the asset that we're buying. And now I can turn around to our potential investor that we work with through Sugar House Investments to tell them about the operator, what the business plan is, what that deal looks like. And yes, get into the weeds with them a little bit. I drove next door to the apartment complex, which in that sense is a competitor, talked to those people, did some ghost shopping there, told them I was interested in the unit, got their floor plans and their market rates, and can see, okay, they did some updating 3 years ago and they're getting this much more rent than the property across the street that we're looking to buy. And so I can start doing some of that comparison as well. I can take that back to my investors and share that type of insight with them. And so that's my job, and the value that I bring is that pre-vetting. And that's what we call them. We pre-vet these hassle-free real estate opportunities.
okay, because people might not understand that, especially if they're new to the game like that. So you're basically not listing them on your website to begin with until you've actually went and did all this work. And then if somebody has a follow-up question about one of the particulars that they may have a concern about, they can obviously discuss it with you and get your feedback on it, or if something's not clear or whatever. Exactly.
We'll do a conference call with the operators. Most of our deals are monthly, but some of them are quarterly reporting and financials and distributions. And at any time, I can jump on the phone with one of my investors to go through what's going on in the property. COVID was a busy, 2020 was a lot of questions. So there's lots of times we were jumping in to answer questions about occupancy and delinquent rents and renters that just skipped out on their leases. And we were having those conversations. But yeah, that's my job. Once we've got this deal in place, my exclusive focus is on the investors, which is what I love. And so I call it investor liaison, investor relations, what have you. But I'm meant to be that guy that these investors can turn to anytime with questions.
Part of the reason that I think people try to do these deals by themselves is, let's say you're buying a single family home and you're going to flip it. And you do the closing and you have the physical asset, you have the keys. You can go in and you can change your mind if you want to or not. But more importantly than that, you have something that you're like, hey, if I want to get out of this, I can go and sell it. I know I have it. It's here. Like it's 2555 Wilshire Street, whatever it is. With these syndication deals, I think people are a little hesitant because they're turning $25,000, $35,000, $50,000 at a minimum over to somebody and they don't know who these people are. Is there a way that I want people to understand these are legal documents? So just to walk through what typically happens is there's an LLC formed for each deal. Is that typically the way it happens?
That's the most common, yes.
Okay, and then you're going to go give your money, but again, it's one of these things, who am I giving my money to? You know what I'm trying to say? You have to get this question before. How do you address that with people to alleviate that concern, because I want people to understand it's a legitimate thing. It's not like some scam or anything like that, but there's bad players in every market. But how can somebody go about vetting to see that they can at least make sure they're putting their money in with somebody who isn't going to fly off in the middle of the night?
Right.
That's, I think, the real concern.
That's a great question. And in my personal experience, I've only seen one bad actor on the operator space, and it was there in Texas. It was a small deal. I think it was a 30 to 40 unit apartment complex. 5 or 6 people put their money in there. Not big enough to have professional property management. The guy who was the lead on it ran off with a bunch of the cash. So others that who were intended to be passive investors all of a sudden had to step up, finish some portion of the business plan, and get it sold to recover just their capital. Forget about any positive returns. They just wanted to get their original contributions back out. So that one I saw, I just felt horrible for those people. Looking back, I knew that guy. I knew that operator. I had looked at him as maybe being a property manager for some of my rental units. So I was shocked. But that's why I like these bigger deals that get into the professional aspect, the professional realm. We're talking about it's not just some Joe Blow guy who says he can put this together. It's an organization. It's an entity. There's the acquisitions. There's the accountant. There's the CPA. There's the SEC attorney. There's the in-house attorney, what have you. And then when you're talking about 150 unit, 200 unit property, those are large enough, excuse me, those are large enough to have professional property managers in place. Many of the property management companies we use, they're listed on the stock exchanges. Your audience may be familiar with some of them. They're large organizations. That's what they do. They do property management. And so it's a different level of visibility than what you could get in a 4-plex, 2-plex, 8-plex, 30-plex, what have you. And at the end of the day, there's some trust to be put, that has to be earned. It would be so scandalous and so visible for any bad actors in these types of deals where they're this large and this many. There's 50 or 60 investors in each one of these. It would be really hard for anybody to get away with anything. What you're really looking for is, can this group execute the business plan? I'm more worried about that than them trying to run off with the money. I'm just more, are they going to make mistakes? And which mistakes are they going to make and how badly? It's more about their skill set as opposed to could they get away with running off with the cash?
And what do they give you? Let's say, so you go into a deal like this. Is there like a portal? Do they give you, for example, do you see the closing documents? Do you see a proof that the property is actually, I'm just saying, I don't know. I'm saying, I'm just thinking of questions off the top of my head so that somebody could be assured, like, hey, we acquired this property. Anybody can get on a webinar and say, yeah, we closed. We acquired the property. Who's to say?
The answer is yes, there is a portal. That's where we house all the documents. That's where people can see their returns, the monthly reporting that gets put there, the financial documents that get put there. As far as seeing the closing documents, I don't think so. I don't know that's the case. I don't think that's there. But these are securities that are written up by securities attorneys. So you see the entity name, you see who the attorneys are that are involved, that PPM, the legalese there, that's the contractual obligation. It shows you what the entity is, what the bank account is. That's where you're going to wire the money. You're not wiring the money, the operator's direct account. You're wiring into this entity that was just formed to purchase this asset into that bank account. And everybody has their copy of the securities paperwork, which is that PPM. And then from there, you've got enough visibility into the operations of that asset that provides me comfort. At the end of the day, there's not that pool of cash that's just sitting there to be mishandled. It's now deployed into that asset. But yeah, obviously there's some level of trust.
And so part of the reason for that too, and this is actually to protect the limited partner, it would be typically, and correct me if I'm wrong, there's typically two different LLCs. There's an LLC set up for the limited partner, and then there's a separate LLC for the general partners. Isn't that?
No, it is a single.
It's the same.
Yep,
okay, it's a single entity.
That's right.
Okay. Oh, with different classes. Okay.
Right.
Okay. So yeah, no. Again, real estate syndication is a real thing. Most people are legitimate in it. I'm just saying, we get these questions a lot from people. Guy's a busy professional, or we do trading and things like that. I got an extra 50 grand here. I want to invest it. What should I do? And then you start talking about it and they're like, yeah, but what about, I don't know who these people are. It's a common question. And I think people just have to get over somebody like you who's done a lot of these deals. It's a no-brainer. You're just like, hey, why didn't I discover this sooner? Right. Until you can get over that hump, it's a little bit of a leap of faith, but the potential reward at the end is also worth it, obviously.
To give you an idea of who some of the players are, in many of these deals that we're trying to win, when we're going out there, a commercial broker has listed this property for sale. We're going in there with our bid, trying to win, and we're going up against a hedge fund or a private equity firm that is also looking to purchase this asset. And that's who's involved. And then frequently the buyers, when we execute the business plan, we've completely optimized this asset. Who likes to buy those already optimized assets are the REITs and other hedge funds. So that's who we end up selling to, because they like to them, right? Yeah, they don't want to go and do a rehab turnaround. We were looking for a 15% IRR. They might be looking for a 7 or an 8. And we can turn that asset over to them at a 7 or an 8 because we've already completed that value add work. And those are the institutions that will happily pick up these assets on the back end.
That's interesting. Talk to me a little bit about capital calls.
Never had one. Pray and pray that never have to do it.
Why? Because you see those in a lot of the deals. So if they're in the event there's a capital call and everybody says that they've never had one, I guess it's just they're putting it in there just in case they need more funds. Or if they did, how would that work, for example? Typically in the PPMs, how is it structured?
In the syndication world, if for a capital call to happen, something had to go horribly wrong. I would look at that as a black mark against an operator, either in their skill set, in their projections, in their assumptions, their ability to execute the business plan. It shouldn't happen. That is part of the capital raise. We're raising the funds to acquire the property, as well as the projected budget, what it's going to take to turn that property around. And that should be sufficient. And there should never be a reason to need the limited partners to contribute more cash. It just shouldn't happen. That said, there may be some legitimate reasons. Even that very first one that we've been involved in and it's gone so horribly wrong, the general partners there, they're well capitalized, and so they've been able to weather that storm. We've never had to put more money in to protect our investment. So in theory, it could happen. It just really shouldn't.
Yeah, I was going to say, because if you're a general partner, especially if you've done many deals in the past, the last thing you want to do is go to your investors with a capital call. You'll come up with some other way to get the money. Probably, I would have assumed, and you would do that only as a last resort, right? Because certainly people won't feel great about it, especially if it's not commonplace. So
me personally, Brad and my wife, if that were our experience, yep, I'm not going to be working with that operator again. So it's important to get in with somebody good who knows how to vet these deals and works with high quality people like yourself, and then get comfortable, do a deal, maybe 2 deals, sit with it for a while, and then once you become to trust the sponsors and the people that you're dealing with, then you'll feel more comfortable with doing that, most likely. Right. So most of the general partners are bringing some or a percentage of their own money to the deal. In other words, you want them to have some skin in the game. Is there a typical percentage that you would look for in that regard? Do you care how much they're bringing it in? Yeah, it's a good question to ask. The general partners should have some skin in the game of their own personal money, not just what they're going to get off of the asset or the acquisition fee. Sometimes they can sneak it in that way, but what are they contributing as part of their own personal funds? I don't know there's a percentage that's worth benchmarking, but if the minimum for everybody else is $50,000, yeah, I'd want to see that the general partners, the key principals, have 100,000, 150, 200,000 in there of their own money as well. So enough that they're in it. They're stuck in it as well, riding alongside right next to the rest of us.
And what you mean by the statement that you made about getting it back on the back end is typically during the closings, they will typically get a percentage at the closing. And if you're backing that out of what they're putting in, they may put in 2 million or $1 million, but they might get $1 million back at the closing, and essentially They have nothing in, correct?
Exactly.
So what about when you take some of the money is raised, but there's typically loans on the property as well if it's a value add property? Is there a particular thing that somebody would look for in the terms of, say, we expect a hold time of 5 years, but there's only a 2-year loan that they've gotten from the bank, and then you have to worry about them being able to refinance it and stuff like that? Is there any sort of that you would want to look at in terms of, are those loans in place already before you do the deal? Or how do you personally look at something like that when you're investing in it?
Yeah, that's a good question. By the point that we're out there raising capital, the loan term should be agreed upon. But we're working the down payment, right? In reality, that's what this is. We're all raising the down payment. So that loan isn't in effect yet. Once we raise that down payment, we get to the closing table, documents are signed, now the loan is in place. that's and the lender has loaned maybe 75 to 80% of the purchase price, and we've come to the table with our 20-25% plus the capital budget to the value add play. But what are those terms? We already know the terms while we begin raising. And so if they've got a 5-year project, but terms on their loan that are only good for 2 years, yeah, I'd be asking about that. It's not uncommon to get these deals with interest only loans for 3 to 4 to 5 year period, and then they switch to typical amortization. And that can be really beneficial, especially when you're talking about, we're only going to be holding this thing for 3 to 4 to 5 years. We don't need to be worrying about paying down the debt. Let's optimize the cash flow while we're doing the rehab project. And so that's pretty common as well. It should be pretty clear and disclose what those loan terms are and what happens when it does convert to now we have to start paying principal as well. And what is that going to do to the cash flows at that point? Those should be in the projections. There should be a clear table in that investment summary of when those things kick in. What does that annual return look like at that point? But yeah, making sure that those debt terms are favorable is certainly a worthwhile conversation to be having.
And would you be looking more favorable on a deal, for example, all things considered, if, let's say, the loan to value that they were borrowing was more along the lines of 50, 60, 70% instead of 80%, or does it matter?
It's pros and cons. It's if it's 50 to 60%, where is that extra portion coming from? Meaning, are the general partners putting that in? Does that dilute the rest of our ownership on the limited partner side? Because we have that many people involved, what have you. So the pros and cons there, and of course, a big pro being that we've got that much equity going into the deal and protect us from any downside, any downturn in the market. So I would say evaluate that asset by asset and understand where those dollars are coming from. Why are we putting in that much money when we don't? Do we have to? And what is that going to do to everybody's equity?
Well, that's a good point that you mentioned, because I want it to be clear to people too. So when you're investing in limited partner shares, you're typically not buying a percentage of 100% of the deal, right? Typically, it's a split with the general partners. The general partners are getting a certain percent, and then you're getting a certain percent for your shares. That's the difference between the Class A, Class B shares, or however they split it up.
Right, exactly. So generally, the really common scenarios are 80-20 or 70-30. So of that LLC that was created for this deal, the general partners might own 20% or 30% of it, and then the limited partners are buying 70% or 80% of it, depending on how that is structured. The investment summary is going to say that, as well as the PPM. And then there very well may be different classes of limited partner shares as well, which can play to limited passive investors' desires for more predictable, steady cash flow, or maybe more exposure to the upside when the property is sold. And so there can be differentiators in that limited partner set as well. But again, all that is spelled out clearly in both the investment summary, the pretty version, and in the detailed lingo of the PPM.
So a few more things I wanted to touch on here. And one of them is this term that comes up all the time, cost segregation study.
Yes.
How important is that, and what are your thoughts?
Yeah, okay. The big one, and that's important. All of our operators do those. So it really just boils down to depreciation, right? These are physical assets that the IRS has stipulated can be depreciated over time. Like many properties, you typically got like a weird number, 27 and a half years of what this house or this apartment complex how quickly it can be valued down to zero, what portion of it, and how quickly that can be done. A cost segregation is it's an engineering report. It's an engineering firm that goes in there and looks at all the various components of this property, the HVAC systems, the flooring, the gym, the roofs, and some of those can be depreciated in much faster timelines than 27 and a half years. And so the cost segregation, that's the name of the study, that the engineering report that's going to tell you what portion of this property can you depreciate on different timelines. And so then we call that bonus or accelerated depreciation. And then what that does, it increases our passive losses in that short holding period. So if in years 1, 2, 3, 4, and 5, while we're owning this thing, we're taking advantage of that accelerated depreciation. We're getting the monthly cash flows, but then at the end of the year, we get that K1, that income statement that generally shows a passive loss. Our portion is the passive investor. What is my portion of that accelerated depreciation that I can then take a passive loss against? So it's just the cost segregation is simply a way to capture higher amounts of that depreciation more quickly.
So do they give you these reports at the end of the year so that you can use them for your own taxes? And do all sponsors do them?
Not every sponsor does them. Every sponsor that I work with does. What we could make that engineering report and that cost segregation study available to anybody. But where that shows up is on the K-1 all of the investors receive. So that's the tax statement, the statement that you would take to your CPA as they're putting together your tax return at the end of the year. That K-1 is where your portion of that accelerated depreciation would show up.
So if the cost segregation study is not done by a particular sponsor, number one, would you not do a deal if the cost segregation isn't done by them?
I don't know. That's a hard line in the sand, but I can't imagine why they wouldn't do it. They would have to have a very good reason as to why not.
Because you said not all of them do.
They're expensive. They cost $7,000, $8,000, $9,000, $10,000, $15,000, depending on the size of the asset to do these. And so if it's a 200 unit deal, it likely makes sense. If it's a 60 unit deal, it's not likely going to make sense to do one of these studies. So it has to have the scale involved. And it's simply a matter, you're going to get better tax treatment showing up with this significant passive loss.
Right.
Again, depending on your scenario, do you have passive gains to offset? And if that's not important to you, then maybe that's not a hard line in the sand.
But you want those tax breaks, right? That's part of the reason why people do this. So if they don't provide the study, it's going to cost you probably a lot more because you or your accountants, because somebody's going to have to go through these documents and determine how to write it off themselves, correct?
No, really, you're just going to get that. K-1 is going to tell your accountant everything that he or she needs to know about this investment vehicle that you've put your money into. Then, and the general partnership for this entity have already done the depreciation based for that asset, whether there is a cost segregation study done or not. That's going to be reflected on the K-1. Okay. So the only thing that your accountant has to do is input that K-1 into their software. It's just a matter of, do you want that K-1 showing a gain or a loss? And if you've got other passive income, hey, it'd be really nice to offset that with some passive loss as well. Not everybody has passive income, but there's other ways you can use that. If, for example, being a designated real estate professional, and that's a topic for another day, where you could actually offset active income with passive losses. That's powerful, but it's a very individualized scenario.
So you're going to just basically get a K-1, and it's going to say, essentially, here's the distributions you got for the year, and here's what you can write off.
Exactly.
So net, this is your loss or your gain.
Exactly. You got it.
Essentially.
Yep. It could be a pretty simple statement that your accountant knows exactly what to do with.
Okay. Somebody looks at a deal. They've taken all these things into consideration. They've decided they're going to sign. They sign the PPM. I'm assuming then they send the funds. And what am I doing now? I'm waiting for the close, or what do I do at that point?
Yeah, it's a sit back and watch the money come in at that point.
Okay.
We'll notify. Exactly.
Yeah.
Well, we're buying a cash flowing asset. So there is going to be cash coming in from, if we close on the property June 10th, first distribution might be September 1st, right? As you get that first partial month and then a complete month done. Now the distributions start coming in on a monthly basis. Some of our deals do quarterly. Most of them are monthly. But yeah, so we'll send out an update saying, hey, congratulations, we have closed. You are now an owner of this asset, and holler with any questions, but congratulations. And then expect to see monthly updates from us going forward. And that's what we'll share. Though we'll be putting the monthly or quarterly financials that get posted into the investor portal. And then most of our investors, we pay via ACH deposits. And so they should see that just on a regular cadence going forward.
And you're saying that the updates are typically monthly, and are the distributions monthly, or are they more quarterly?
Most of our operators, yes, we're doing monthly reports with monthly distributions. We do have some, like the self-storage one that I mentioned, the fund that we're doing with them is a quarterly reporting, quarterly distribution.
And sometimes depending on what they're going to do with the property, whether they're going to maybe fix up a bunch of units when they first start, maybe you get a little bit less of a percentage in the first few quarters or first year until they ramp it up and rehab those. But that's a typically normal type of thing as well, probably, I assume, right?
Exactly. Yep. That's the typical cadence. Year 1, 18 months, 24 months, those cash flows are going to be pretty small. And then that's going to grow over time as we've executing this business plan and optimizing the rents, increasing the revenue, decreasing the expenses, and then those will grow over time. But a big chunk of that annualized return is going to come from the equity event when we sell and we all cash out.
What about this idea? Let's say they're going to hold for 5 years, and sometimes you'll see it where they'll say, we're going to refi out in 2 or 3 years and try to return most of your capital. Is that a reality in a lot of cases? Or
yes, we've had that happen multiple times, and that's a great scenario, to be honest.
That's something you want to look for, you would say?
As an option. It's not going to be possible on every deal. And I would just look for it as a nice bonus surprise when it does happen, to be honest. It means if you put 50,000 in, all of a sudden in month 18, 24 months, whatever, it makes sense to refinance based on, hey, we've got this, the value of this property has increased significantly. Rates are still low. Let's go ahead and refinance. And now everybody gets half of their equity back out, but you're still sitting in your capital contribution, but you're still sitting in that same equity position of getting that monthly cash flow going forward. Everybody's happy. You've got,
of course,
you've reduced your exposure. You're looking for the next deal right away to jump in. Wow, how do I do this again? So it significantly increases the IRR, but I just look at those as just a nice bonus.
So one more question. So I know that I years ago that the gold standard, so to speak, for IRRs used to be, and this is not typically for new construction. This is typically more for flowing existing properties, used to be 20%. And they said in the recent years that's been lowered to maybe around 15 or something like that. Is that true? Or
yes.
Is there something you look for? Are there numbers you look for on a particular deal?
Yeah. It's 15, 16, 17 is pretty common. It's pretty hard to project. And I would be nervous of anybody projecting anywhere above that right now because the real estate market is so hot. There's a lot of dollars at play looking for deals. And so it's competitive and people are willing to pay premium dollars for it. So over a 5-year hold, a 15% IRR, 15 to 17%, we should say, a 2x equity multiple, meaning simply, okay, you put 50,000 in. If we run for 5 years, a 2x, meaning we should be able to double that, your contribution based on the monthly cash flows and then the gains from the sale of the property. So that's a pretty common scenario, 15 to 17% IRR, 2x equity multiple. That's where most of our deals are sitting at.
Okay, that's good to know. So I think that this has answered a lot of questions that people have. And so if they're looking for another option to invest in, or maybe they're even working with different syndicators and they want to see what you have to offer, how do they reach you so that they can talk to you more about your current offerings? Yeah,
best way to do that and to see what we have coming down the pipeline is connect with us at our website, sugarhouseinvestments.com. That's where you can see some of our past deals. Put your email address in there and you'll be able to see the future deals that come down the pipeline. If you're accredited, we can talk about the live deals that are going on right now. If you're not accredited, hey, well, let's jump on the phone and get to know each other a little bit. And I can let you know about future deals as those come down the pipeline that are appropriate. But yeah, sugarhouseinvestments.com is the best place to connect.
Are you on social media as well?
I've got company pages out there for on all the different platforms, but the place where I'm most active is on Twitter. I signed up for Twitter probably 12 years ago, never used it. And about 7 or 8 months ago, discovered there's a whole lot of activity with really smart people going on Twitter right now. So I've been active there and it's been really fun. So I'm at Brad Shep on Twitter.
Okay. And we'll post all that on the website episode page and in the show notes and everything like that. Now on your website, is this something where they're going to be able to see everything about the deal to start, or do they have to register with you first to get more details about a particular investment, or do you see everything right out of the gate?
Yeah. So the way we generally work that, if after people have signed up for our email list, and it's not something we're going to be spamming people with a bunch of nonsense about, it's really just as we have important updates and new deals coming down the pipeline. For those who have told us that they're accredited, we'll put it in the body of that email. Here's the deal. Here's the basic parameters, and just fits in the body of an email. Basically, just 5 bullet points of what the deal is, why we like it. If you're interested in learning more, you think you might want to participate, just raise your hand saying, hey, I'm curious. I think I can meet that minimum. And then I'll send you that full investment summary from there. And then we can provide more details should you want to move forward. But yeah, so it's a really soft approach, real quick highlights. Raise your hand if interested. We'll get you more details. And about how many deals are you, on average, doing a year or bringing to the table? Sure. It's not a high volume market. We look at hundreds, but average year, maybe 10 to 12 deals. Okay, that's a good amount. We almost always have something that we're raising for, but yeah, it's not like we're a deal a week kind of a scenario. We are very selective on what we work on. Well, Brad, this has, again, been a whirlwind of information, and I think people are going to really love it, especially if they're interested in this and are looking to invest. So it's great having you on.
And maybe we'll have you on again and talk about some other stuff down the road, hopefully. And we'll go from there.
Hey, thank you very much, Rick. I really enjoyed it. Great questions. I need to go get a drink. My throat's scratchy. I hope some of those answers were helpful. But yeah, I would definitely love to be back on anytime and hope that was valuable to your listeners.
Absolutely. Have a great day.
Thanks, Rick. You as well.
Talk to you soon. Bye-bye.
Bye.
Hey, everyone. If you enjoy these episodes here on the show, please don't forget to follow us on your favorite podcast platform wherever you listen to audio. It's a great way to be reminded when new episodes are released. You can also rate and review the show as well, which helps to spread the word to new listeners. Also, if you're interested in trading the financial markets and curious about stocks, options, futures, Forex, and more, please head over to my website at rickmazer.life. Be sure to join our mailing list. We are currently in private beta with Enlightened. Enlightened is a trading community and will provide great information and lots of free resources. We have tons of things planned for expansion to give anyone interested in becoming better at finance, investing, and trading your money some great opportunities. Get on the mailing list today and let's get trading and better at managing our money. So that's it for today's show. Let me know what you thought of it. I'd really appreciate it, and it will help make these shows better for you. Feedback is a very valuable tool to get better at anything. You can hit me up at Twitter at rickmaz1106, that's RICKMAZ1106, or on Instagram at rickmazer1, RICKMAZUR1. Use the contact form on the website, rickmazer.life, and we'll also have everything in the comments section for each show page. I personally look at all the feedback on the site as often as I can. Finally, if you have anything to contribute or ask, or would like to appear on the show through an interview or one of our other segments, you can leave a voicemail at 1-800-590-0174 or by contacting us on any of our socials or use the contact form on the site. We'd love to hear from you. I consider us all a community, a group. Let's remember, in today's more challenging world, we are people first. We're humans who just want to be treated as such and live in a place where we can all prosper and live well. Bye for now. Until next time. See ya.